In mutual funds, it's actually not your scheme selection process, but what is more important is which category are you really investing your monies in. There are 1500 mutual fund schemes, and if you have to build a 4 5 scheme portfolio, it's not as easy as a lot of people like us keep telling you. And the first, or rather the most important thing before you actually make a good mutual fund portfolio is for you to understand what are the various categories in which you can invest. Selecting the right category is far more important than selecting the right scheme, and that is what we are going to do in today's video. Hi everybody, my name is Kirtan Shah and I'm the co-founder at Financial Planning Academy. And after a long time, I'm recording a video again, but with an intent to do multiple videos. First, to start with, on making you a better mutual fund investor. In today's video, what we are going to do is very simple, because I believe that understanding categories and picking the right category is far more important than picking the right schemes. I'm going to help you all understand today to understand categories in mutual fund investing on the equity side. So, of course, when you look at SEBI's categorized schemes into equity schemes, into debt schemes, into hybrid schemes, into solution oriented schemes where you have child plan and retirement plan and all of that, and others where you have fund of funds and ETFs and index. In today's video, our focus is only to demystify what are the various equity schemes and what do you need to know about those equity schemes. So today, at the time of recording this video, while I'm talking to you, there are 12 categories in which SEBI has split the entire equity investing universe for mutual funds. What you see in front of you are those 12 categories. What you have to understand is, before I start talking about this subject, is each of these categories will largely end up investing either in a large cap stock, a mid cap stock, or a small cap stock. Now, when I say large cap, SEBI in mutual funds very categorically defines that the first 100 stocks, or the biggest stocks, or stocks with the highest market capitalization, the first 100 are termed as large cap. 101 to 250 market cap stocks are termed as mid cap, and anything below 251 is termed as small cap. Now keep this in mind, is because this is an extremely stringent rule that all AMCs really have to follow, directed by SEBI, to make sure that when they say that my fund is a large cap fund, they are actually doing large cap investing, and so on and so forth for mid and small. Now, if you look at this very closely, all of these 12 categories that you see here right in front of the screen are actually divided into different categories, keeping two things in mind. The first is where we are saying that these categories are different from each other because of the market cap they are investing in. So some schemes are investing in large cap, some are investing in mid, some are investing in small, and that's how they are different from each other. The second reason why a lot of these categories are different from each other is the style of investing. So you will see that there are some funds dedicated to value style of investing, there are some which are dedicated to dividend yield style of investing, and so on and so forth. But broadly, all of these 12 categories are largely different from each other, either because of the market cap investing that they are doing or the style of investing that they deploy. Now let me dive a little deep so that you all understand what am I trying to say, and understand a little more about equity categorization under mutual funds. So the first category that I'll talk to you about is large cap. As per SEBI's directive, in large cap funds, 80% of the money the mutual funds will have to invest in the top 100 large cap stocks in India, right? The remaining 20% can be invested anywhere. So your portfolio either can be 100% large cap, your portfolio can be 80% large cap and 20% of mid, small, or even fixed income, right? Or your portfolio can be 80% are large cap and 20% are completely fixed income. That completely depends on the fund managers, but largely you don't see a lot of funds taking fixed income bets. So you will definitely see large 80% large cap. The remaining 20% can be split between large, mid, and small. Now what has happened is this categorization what you see here of what should large cap do, what should mid cap do, what should small cap do, came in 2017 end, so 2018. Prior to that, fund managers really had a lot of flexibility. But in 2018, when this came up, a lot of fund managers' hands got tied. Now they know that in large cap, they cannot do anything but have to invest 80% of their money in the top 100 stocks. Over and above this, there are multiple other problems. SEBI has guidelines around how much can you really invest in one stock, how much can you invest in one sector, and all of that. And which is why this category large cap has found it very difficult to be able to beat the index. So anybody who wants to do large cap kind of investing using equity mutual funds has two routes. Either you use the passive way of investing, so invest through index or ETFs in the large cap space, or if somebody here who's slightly aggressive, looking at better risk adjusted return, instead of large cap, invest in these two categories called flexi cap or focused, right? So first thing that I want you to understand, though large cap funds are not able to beat the index for multiple reasons that I spoke to you of, does not mean that you don't need large cap in your portfolio. You definitely need large cap in your portfolio, but take that exposure using the flexi cap or the focus fund instead of trying to do large cap funds directly. So what are flexi cap and focus funds? Flexi cap and focus funds are categories in which the fund manager has full flexibility to invest in whichever market cap she wants to. So the fund manager can do 50% large cap, 25% mid cap, and 25% small cap. Or the fund manager can do 50% mid cap, 25% large cap, and 25% small cap. So the fund manager has the flexibility to do anything in flexi and focused. But if you look at it, for all practical purposes, for all the flexi and focus funds available in the industry today, all of them are pseudo large caps. What I mean by that is that if you see, you will understand that in flexi cap portfolios and focused portfolios, you have 75-80% large caps only, right? With a little bit of movement here and there in mid and small. So in my opinion, flexi cap and focus funds are pseudo large caps, are a good replacement to large caps, where the fund manager really has the ability to move higher in small cap and mid cap if need be, which is not the case in large cap. You should actually look at flexi and focused in terms of investment when you want to do large cap investing. Now you would say, what is the difference between flexi and focus? The difference is very simple. Both can invest across market caps. But when you talk about flexi cap's portfolio typically is expected to be around 50 stocks, whereas focus funds are not allowed more than 30 stocks. So focus is a slightly more concentrated product category, hence will have slightly more risk return in favor. So somebody who wants to take large cap bet and is okay with aggression can look at focused. Somebody who wants to take a large cap bet but is not very aggressive can look at flexi. So look at it in that sense. Now if you look at the other categories, like you have the dividend yield, value, contra, or ELSS, right? The problem with these 3-4 categories is that the definition is not very clear by SEBI. Like say for example, if I talk about dividend yields. Now theoretically, dividend yield fund means that you are expecting that the fund manager will invest in stocks that pay you a very high dividend. That's the logic of calling a category dividend yield category. But actually there is no definition by SEBI of what do you really call as a high dividend paying stock. Similarly, when you look at this category called value fund, right, you will typically expect that when I invest in this category, the fund manager is going to be doing value style of investing or investing in stocks which are cheap. But again, there is no real definition from SEBI of what is value investing or what is a cheap stock. Like in large cap, you know the top 100 are large caps. But what is value, what is dividend, there is no definition as such. Similarly, contra. Now you are going to expect that if you will invest in a contra fund, this fund will take a contrarian strategy of what is not working in the market is what they will invest in. But again, there is no definition of how do you define what is working and what is not working, right? So what I want you to understand is that dividend yield, value, contra, all these three funds, by whatever definition SEBI is given, that's okay. But in the real world, all of these funds are also very similar to what the Flexi Cap fund does. So 70-80% of the investments will be in large cap, a little bit here and there will be in mid and small, right? And same is the case with ELSS. So in ELSS, 80% of the money has to be invested in equity, the remaining 20 can be wherever. But ELSS is this fund where you get 1,50,000 of deduction if you invest, but there is a 3-year lock-in, right? Now, why did I jumble up my order? Because I wanted you to understand that in large cap, they are not able to beat the market because of a lot of restrictions that I spoke to you of. So anybody who's looking at a replacement to large cap, right? You have flexi cap, you have focused, you have dividend yield, you have value, you have contra, and you have ELSS. All of these categories, though they might have different names, but they are all largely large cap funds the way it existed before 2018 when this categorization was given. So instead of doing large cap active investing, you can either do passive in large cap, invest in Nifty index or ETFs, or select between flexi, focus, dividend yield, value, contra, and ELSS, and you will largely have the large cap experience. Talking about the other funds. The second category is large and mid cap. Here SEBI says that 35% money has to be in large cap, 35% money has to be in mid cap, and the remaining 30% can be wherever. Now, if you practically look at the industry, largely this portfolio is 60% large cap and 40% mid cap. In mid caps, SEBI requirement is that 65% of the money has to be invested in mid cap. The remaining 35% can be invested wherever you want. Now, industry average, this 35% is largely tilted towards large cap. So in a mid cap portfolio, you will see 70-75%, 80% in some extent to mid cap, and the remaining money is largely allocated to large cap. Small caps, 65% of your money is invested in small cap, remaining 35% can be wherever. Now there are few funds which are true small cap funds where you will have the remaining money here in mid cap, but largely the remaining 35% is again split between large and mid, right? So large cap is simple, mid cap is simple, small is simple, and large and mid is also very simple. Very clear cut definitions given here. Now there is this very new category that has really come up called the multi-cap fund. What the multi-cap fund typically does is they are expected to put 25% in large cap, 25 in mid cap, and 25 in small cap. And again, the remaining 25 can be adjusted wherever, right? This is slightly a newer category. We don't have a lot of history of funds who've done multi-cap kind of investing, and hence it is to be seen how this category really plays out. But a word of caution here is a lot of us are investing in multi-cap funds saying that you will get exposure of large, mid, small, all three in one fund. Please don't look at this fund in that context, because what has also to be seen over a period of time is that how is this one or two fund manager able to manage money across large, mid, small, all three in one fund. Because look, people specialize as a large cap investor or a mid cap or a small cap investor, and this fund actually is expecting you to do equal weight investing across large, mid, small. It is to be seen that how one fund manager is comfortably being or going to be able to do this. Now you might say that this is exactly what Flexi or Focus also does, right? They are free to choose wherever. But please understand, like I told you, Flexi, Focus are more large cap. 75% of the money there is large cap. Over here, there is a clear categorization in multi-cap that you need equal weights in large, mid, small. So mid, small cannot be taken lightly in a multi-cap investing universe. So definitely do keep that in mind. Don't invest all your money in one multi-cap fund saying that you will get exposure to all three market cap. That might prove to be a wrong strategy. And the last thing that you have to understand is what is sectorial or thematic investing. Look, what sectorial investing, suppose if I say that there is an infrastructure fund, what that really means is that 80% of the money that gets invested in that fund will have to be invested in infra stocks. So an IT fund, 80% of the money has to be invested in IT stocks. right? Pharma fund, 80% of the money has to be invested in pharma stocks. Now that can be across market cap, need not be large, mid, small. That can be anything. That's on the fund manager's discretion. What is thematic investing? Thematic investing means that, let's say if I say there is an infra theme fund. What that means is that indirect ecosystem of infra can also be invested in. Like say for example, in an infra theme fund, I can invest in banks also, because banks fund infra companies. I can also invest in a cement company because that's the raw material that is used to build projects. So I can invest in sectors that indirectly are connected with infra as a sector. Now, sectorial and thematic investing, in my opinion, is meant for sophisticated investors, because it's not just the time at at which you should enter in a theme that matters, but extremely important is when you exit. If you're not able to exit the sector at the right time, you will see very lumpy and very volatile experience while you invest in sectorial and thematic funds. So in my opinion, only if you understand when to enter and when to exit, and you can time sectors, that is when you might want to consider a sectorial fund. Uh, to sum it up very quickly, I'm saying you need large, mid, small, all three in your portfolio. If you want to take large cap exposure, you have two things that you can do. You can do index investing or ETFs if you are a largely moderate kind of investor. But if you are an aggressive investor, then you can look at doing flexi cap, focus, dividend, value, contra, ELSS. They are all, irrespective of the name, large cap, pseudo large cap focus funds. Mid cap, small cap, clear categories are given. So if you want to take exposure to mid cap, invest in mid cap fund. You want to take small cap, invest in small cap. Give multi cap some time before you start taking large exposure to multi cap. And it'll be wrong, in my opinion, for you to assume that in this one fund I can get exposure to everything, then why I invest somewhere else. Don't keep that thought process there. And sectoral investing is only for sophisticated investors. Please be careful. Unless you know how to time the sector, please do not take bets in sectorial and thematic. So in this series of mutual fund, that's the first video for you. In the next video, I'm going to similarly talk about debt categories. I'm going to talk about hybrid, and there are some 15 such videos to make you a better mutual fund investor lined up. If you like the video, please request you to like and subscribe to the channel. Specifically, share it with your friends on WhatsApp groups who would you think benefit out of these videos that we've done. Thank you so much, and happy learning.